Thank you, everyone, for joining us today. We are very pleased to be presenting our Q3 23 Top Picks portfolio. I am Rob Goff, the Head of Research with Echelon Capital Markets. Our research team here is very excited to share our top pick names looking ahead to Q3. As you'll see before you, we have our basic introduction. We will try to get right into things, skipping over the overview and roll our sleeves up. We do regret to inform you that we underperformed for the second consecutive quarter. As you can see, it's been a tough start. We were down 6.4% on the quarter, while the TSE Composite and the TSE Small Cap Index gained 1.1% and declined by 4.6% respectively. The TSXV had a tougher time, down by 2%. It's probably the closer benchmark for us, given the constituents within our top pick portfolio. So we are hurt by not having a larger cap focus, but we have our discipline, and we do stick to our discipline of small cap, catalyst rich, fundamentally well-run, well-positioned companies in our portfolio. You know, we continue to highlight that our 5-year gain at 75% has significantly outperformed all index measurements. And here we have the numbers to support that. You see the 75% return over the 5 years. Our alpha against the TSX is 30%. The TSX small cap is 57%. The TSXV is 91%. We were very disappointed to see that our 3-year returns actually are trailing against the larger cap indices, although still well ahead of the TSXV, where it's been a tough 3-year period. When you look at the TSXV, essentially flat across those 3 years. In terms of the actual names, we are very pleased to note the strong performance by Stefan's Diagnose, alongside with the strong returns associated with ReadyShred. When we look at those that hurt the portfolio, Quib's decline can be attributed to both its Q1 outsized returns, I believe it was 54%, along with a painful misstep by the company in terms of communicating an ATM to the capital markets. I must then bear the blame of the losses associated with both Quizzitive and Converge, two names that have been long-standing constituents within the group. In terms of looking forward, with the top picks for the Q3 23, we had 5 names removed from the prior quarter's portfolio, those being BSR, Converge, and Playmaker. We had to remove 2 additional names, Calian and ReadyShred, regretfully associated with Amber's departure. We look to be resuming coverage against those names, and we will give them full consideration at that time. We will discuss the move to Dream from BSR, along with the removal of Converge, where we elected to focus on Quizzitive. For Playmaker, it remains a solid favorite, a class act, well-managed, well-positioned name. However, we did see it offering less in the way of catalyst-driven returns, particularly when we lined it up against both Neat and Think. Those are 2 SaaS companies with significant momentum and catalysts expected within the quarter. In terms of jumping into those names, the first one we have here is Neat. As a new member of the top pick portfolio, it has had an incredibly successful start to the year, having announced 5 major contract wins over the past 6 months. When they form a contract, it's typically with a global pharma leader where they have 15 of the top 20 global pharma leaders. They provide a software platform under a software as a service model where they perform the validation, the manufacturing validation process in a digital manner for the global pharma company. These digital records are critical in terms of ensuring FDA monitoring and approval. Our perspective here is that in gaining 15 of the top 20 amongst their client list, they're becoming the de facto standard. Clearly, the FDA approves of and monitors and is well aware of their platform. It is the go-to. We think this sets the company up for success and ultimately takeout, where one of the global leaders will likely take a look towards Kneat. For this reason, we point to the valuation of Kneat within the context of a Veeva or an Aspen Technology who could be a potential acquirer. When we look here, we see that Kneat is trading at 6.5 times 23 revenues, 9.7 times gross profits. When we look at the larger would-be acquirers, they're trading at 12.5 times revenues, 17 times gross profits, or in the case of the slower growth Aspen, 9.6 and 12.6. So for them, it would be a strategically accretive move to acquire Kneat. It would be a valuation accretive move to acquire Kneat. So a quality name, we recommend it for its own right, but recognizing that the return profile would and should include that of potential takeout. Our second new name that is, Think Research, where we have a speculative buy, price target of $1.10. Now, Think is technically a telehealth name, but we see it more as a SaaS, software as a service technology name, serving the health market, where they provide digital services, tools, and education to hospitals and pharma and physicians. Notably, its shares are flat for the year to date after declining a precipitous 77% in 2022, along with the broader sector decline. Consequently, Think is now valued at 1.3 times, 8.6 times our current year revenues and gross profits. Our gross profit and EBITDA. EBITDA being the gross cash flows. In contrast, Well Health has gained 67% for the year to date, leaving it valued at 3.6 times same gross profits and 13.3 times on an enterprise value to EBITDA valuation measurement. Here, we see Think as being a strategically accretive move for Well or another would-be pursuer. We also see the opportunity for it to be a financially and valuation accretive move in the marketplace. So our view here is attractively valued at 8.6 times gross cash flow or EBITDA, where there is strong momentum. The company has announced significant contract wins for the year to date that went unreflected or are now unreflected in the marketplace. We expect it to be catalyst rich over the ensuing months with further contract wins, yet it is trading at a depressed valuation. We like it based on a standalone basis. We like it as a takeover candidate. Moving on to the IT services. where we narrowed our focus from Quizzitive and CTS as longstanding constituents to just go with Quizzitive. In part, that was the 25% decline on the past quarter, leaving Quizzitive with, we think, a greater rebound prospect. Our view here, or our investment thesis, is relatively simple. We like the IT services marketplace. We see it as a growth marketplace as companies are driven to digitize and realize efficiencies. We look at Quizzitive itself as a company that manages expectations and outperforms against those expectations, so we assign very low forecast risk. When we get to the valuation part of the equation, we find it very attractive against the more traditional consolidated valuation measurements, such as EV to EBITDA, EBITDA being that gross cash flow, where it is trading at 6.3 and 5.1 times EV to EBITDA, where peers are around 8.5. It also, though, has startup losses associated with a payment platform. Take out those startup losses, and the multiples are then further depressed to 5.2 and 4.4. It's really a company where there are three different assets. There's an IT services component, there is a payment component, and there is an upstart payment processing platform to become commercial exiting the year. With the three different components, we submit consideration for a sum of the parts valuation reflecting each of those components. There, we can very easily support a sum of the parts valuation of $1.53, which looks crazy given the share price at 36 cents. But trust me, we've had a number of discussions with investors, with shareholders, going over the assumptions within the sum of the parts valuation components, and they support them. They are also typically long the stock. Maybe they're biased, maybe they're insightful. We do believe that we can very readily, very strongly defend that sum of the parts valuation. Some of the parts are only good where you realize on it or where there's a catalyst. We could see the company sell a minority stake in one of those components that would bring it a lower cost of equity, surface the value, and establish a path for inorganic growth. So we do see such a catalyst to moving away from the consolidated yet attractive valuation measurements to the sum of the parts, which is simply compelling. So enough on Quizzitive, and glad to entertain questions afterwards on it. But for now, we are moving on to healthcare, and I'm very pleased to have Stefan on for you. Stefan, over to you.
Thanks, Rob, and good afternoon, everybody. We're sticking with our same two names, Quipt Home Medical and Diagnose. So while Diagnose continued to perform well, it's up over 80% year to date. Unfortunately, Quipt was a bit of a dog last quarter, for lack of a better term. It gave back part of the strong gains it had in Q1, but it's still up on the year. Nevertheless, we still like both names since they have attractive valuations and upside from potential catalysts in the next few months. So I'll start with Quipt, $11.75 target price. For those of you who don't know the company, they're a US-based distributor of durable medical equipment for at-home care of patients, primarily with respiratory problems. So think of things like ventilators for people with COPD and CPAP instruments for people with sleep apnea. We like the business because of three major drivers. The first is strong demographic tailwinds from the aging population that drives consistent organic growth in the mid to high single digits. The second is we like to think of the company as being in an M&A sweet spot due to its fragmented industry structure. It allows the company to benefit from accretive M&A opportunities, typically paying under 5 times EBITDA pre-synergy for acquisitions. And then finally, there's an ongoing shift to at-home care which of course was accelerated by COVID, but it's certainly lasting beyond the pandemic, because not only do patients prefer to care at home, but more importantly, it provides cost savings to the payers like insurers, because it's cheaper to care for someone at home than in a hospital or a nursing care center. The key catalysts for the company are proof that it will deliver on the synergies from its recent Great Elm Health transaction, that should allow it to meet our expectations for EBITDA margins rising from about 21% currently to above 23% towards the back half of this year. And we also think there's potential for other accretive tuck-in M&A that could lead us to increase our estimates. Given the sell-off in the stock in the last couple of months, Quip trades at a very attractive valuation compared to peers. It trades at about 6 times EV/EBITDA versus peers above 10 times. So with that, I'm going to move on to Diagnose. We have a $1 target price. So Diagnose is an artificial intelligence company with a platform to diagnose diabetic retinopathy. Diabetic retinopathy is the leading cause of blindness in adults. It occurs when unhealthy blood sugar levels in diabetics cause blood vessels to grow on the back of the eye, the retina, which leads to vision loss. The process is asymptomatic. You don't feel it happening, and the only way to identify the problem is by taking a picture of the retina with a special camera that are used by eye doctors and grading the severity. So Diagnose has developed an AI system that does this extremely well and efficiently. Their business model is a highly scalable software as a service approach, where they charge $5 to $10 per diagnosis. So this is a win-win for clinics that charge $30 to $50 for this type of test, since it allows them to see more patients and allows the doctors to be more efficient and focus more on more valuable procedures. So there are about 450 million diabetics in the world, and they're all supposed to have a retina exam at least once a year. So this is really a blockbuster market opportunity. The company has a number of eye clinics and optical retailers that are using and piloting their technology. Their biggest client is New Look, which is Canada's largest optical retailer with about 400 stores. They signed a deal with them in 2021, and they're in the process of installing their software across their store base. So while this has been a bit slower going than we had hoped, if they can eventually get their software installed across the store base, that should be sufficient for the company to reach cash flow positive. The company's also been very active on the business development front, and is working on winning some meaningful contracts, which we hope will and expect to continue in the coming quarters. Their biggest opportunity by far is with Echelon, which is the biggest player in eye care space in the world. They have over 15,000 retail locations. In 2021, the company announced a memorandum of understanding with Echelon, and the hopes is that they can finally conclude a deal in the coming months. This, of course, would be a complete game changer for Diagnose and would be a strong catalyst for the stock. So with that, I'll hand it off to David Crystal, who will tell you about his picks in the real estate sector.
Thanks for the intro. As Rob alluded to earlier, for the quarter, we have dropped BSR REIT from our top pick portfolio, and that's given easing rental rate growth and an increase in incoming new supply in their core Texas markets. Over the 7 quarters that we had included the REIT in our top pick portfolio, a Canadian investor would have seen a total return of minus 10.2%. Somewhat disappointing, though directly in line with the broader Canadian REIT index. So, obviously with rising interest rates, we're in a bit of a tougher tape for the REIT space in general. And it did perform, directly in line with the broader index. We still like the name for the quality of its portfolio, the long-term growth in its core markets, and attractive current valuation. But given the current interest rate and inflation environment, we favor names with immediate pricing power and stronger near-term organic growth. So as such, we have 1 returning pick and 1 addition to the portfolio for Q3 23. So we'll start with our returning pick, which is Flagship Communities REIT. The REIT owns a portfolio of manufactured housing communities in the US Midwest, providing tenants with the most affordable housing option available in their markets. So the trailer park industry has historically proven exceptionally resilient. They posted 20 plus consecutive years of positive organic growth. This is throughout all economic conditions. COVID, the 08-09 housing crisis, dot-com boom and bust. They really weather all economic storms and provide steady returns. Given recent significant deterioration of home ownership affordability due to rising mortgage interest rates, as well as a massive increase in apartment rent that we saw over the last 2 years post-COVID, Flagship's offering now enjoys a considerable cost advantage relative to the alternatives. And as a result, we see significant pricing power when it comes to increasing rents. We saw in 2023, they increased rents portfolio-wide roughly 8%. We've seen a lot of the private equity peers that have acquired assets and increased 20, 40, 50, doubling rents in a very short time period. Management's got a 25 plus year history of acquiring underperforming parks, focusing on improving operations, increasing occupancy, driving NOI growth. Their current portfolio sits at 83% occupancy. We see considerable upside and room for stabilization into the 90% plus range. On top of the organic growth we expect to see from rent increases and occupancy gains, we'd also highlight that the balance sheet is highly defensive. They have no debt maturities through 2027 and an average remaining debt term of more than 11 years, so no rate risk in the near term. Finally, they trade at a significant discount to the US peer group. They trade at a 30% NAV discount and 13 times forward FFO. The US comps trade at 20 times forward FFO. So we see the name as a high quality defensive name, and current valuation in our view is an attractive entry point. Moving to our new addition to the top pick portfolio, Dream Industrial REIT. The REIT owns a portfolio of more than 40 million square feet of industrial properties located throughout Canada and Europe, as well as a growing development pipeline focused in their core Canadian markets. The REIT benefits from exceptionally tight industrial fundamentals, which have seen a massive increase in demand over the last few years as a result of the acceleration of e-commerce on the back of COVID, a shift from just-in-time to just-in-case inventory management in light of a number of supply chain disruptions, and a push for reshoring, nearshoring, and friendshoring of manufacturing in light of higher transit costs and rising geopolitical uncertainty. This increased demand has resulted in tightening vacancy and exceptionally rapid rising rents, which has left a substantial gap between the current market rents and the REIT's in-place rents. Management sees roughly a 40% upside to rents in their current portfolio, which should support high single-digit to low double-digit organic growth over the next several years. Earlier this year, Dream formed a joint venture with a major sovereign wealth fund and took out the largest Canadian pure-play industrial REIT, Summit Industrial, in a $6 billion transaction in which Dream acquired a 10% interest. So not only is the rent upside in this JV greater than the REIT's existing portfolio, but they also earn property management fees on 100% of the asset base while only putting up 10% of the capital. So this is resulting in a fee stream that should grow considerably over time. We would expect more acquisitions within this joint venture, which again should be highly capital efficient and offset their third-party asset management fees. Though the valuation is largely consistent with its largest Canadian peer, we like the name for its considerable organic growth, and as mentioned, that growing stream of third-party fee income, which is unique and quite a large and growing stream of fees for the name going forward. So with that, I'll turn it over to Rob, who I believe is filling in for Andrew.
Thank you, David, and my apologies. Andrew is currently on holidays, but he did pass along a few comments. Essentially, he is returning both High Tide and Verano to the top pick portfolio. Notably as Q2 23 top picks, High Tide posted, a share price decline of 9.3%, while Verano registered an uptick of 0.8%. Both High Tide and Verano outperformed Andrew's preferred benchmark, which is the new Cannabis Ventures Global Cannabis Stock Index. That index itself was down by 11.8% on the quarter. High Tide also significantly outperformed the 44% decline for his tracking group of Canadian cannabis retailers, while Verano outperformed the 3% decline of the actively managed Advisor Shares Pure US Cannabis ETF. So despite challenging market conditions, Echelon's cannabis top picks have outperformed the global cannabis stock index in 14 of the past 16 quarters. I think that speaks very well to the strategy of picking quality names within the space. Quality names measured by the strength of the portfolio, the strength of management, and financial resources available to those. Very quickly, as I would do it a disservice, here we are with the High Tide. Andrew will point out that, or would point out that, it is valued at 7.1 times current year EV to EBITDA, or 5.1 times 2024 based on his estimates. The company itself has a unique discount club retail strategy where they exploit their vertically integrated operations, which allow them to compete through the club model where others are challenged to do so. Now, for today, with respect to Verano, I should note solid balance sheet, positive free cash flow generation in terms of free cash flow at 75 million on the year. That would give you a free cash flow yield of 7.4% against the market capitalization. And on valuation, Verano is at the second lowest EBITDA multiple of the large US cannabis companies, where it is currently valued at just 4.7 times Andrew's 2023 EV to EBITDA forecast. So the discount there is 36% against the average of 7.4 for those US large cannabis companies. Now, today, we're also pleased to have with us Jason Mooney from our debt capital markets to share his views on some of the active cannabis debt instruments. Jason, if you were there.
Good afternoon, everyone. Nice to finally get on one of these calls and introduce myself. If you don't know already, Echelon now offers an institutional fixed income trading and sales platform through myself, which has been going since January. We're trading lots of different products. Our main focus has been on cannabis and the energy sector, but that we're not limited to that. But given the fact that I've just been given this segue on the back of Andrew's absence and Rob's very kind introduction, I'm going to speak a little bit about cannabis debt. Obviously, we started the year probably at a level was probably a little bit, too strong for where the sector could, basically find buyers. Since then, we've seen the debt product sector come off significantly, and it's now provided an excellent opportunity both for existing and new players to get exposure to larger MSO debt products and get some considerable yields into their portfolio. I'm going to give you my top pick, which is Trulieve have a short-dated bond. It's the Trulieve 9 3/4 of June 18, 2024. It's a sub 1 year piece of paper. We're in a position where we can offer bonds at a price of 95 1/4, which is a yield of 15.4% yield. Quite amazing that you can actually buy a company of this caliber with sub 1 year duration at a 15.4% yield. We kind of, if we were going to rate these bonds internally, we'd probably put them at a double B credit. And double B credits probably trade around half that yield level in the States, probably around a 7.5% yield. So there's some significant upside in putting these bonds in your portfolio. We think there's very limited risk downside with these bonds, given the fact that Trulieve has got a lot of cash on the books, and they're generating a lot of cash flow. So if anyone's interested in that, please reach out to myself. You can find me on Teams, you can find me on email. Just lift up any rock at the firm, and I'm sure I'm lurking somewhere. So on that note, I'll leave you with it. But if anyone has any questions on institutional debt products, please reach out to me. I'm more focused in probably your 1 to 2 million and up kind of sizes. I'll leave the smaller sizes to our very capable retail team that have been servicing you guys for several years. Thanks for your time.
Thank you very much, Jason, for making the time and for sharing your insights. It's great to add that additional perspective in terms of credit and equity markets. So thank you. And with that, I will then turn the page to the metals and mining space.
Great, thanks, Rob. So we're sticking with our kind of long-held top picks. We'll start off alphabetically here with Osino. So the shares actually hung in pretty well during Q2. They were actually up just short of 4% during the quarter, and really that compares pretty well with the VanEck Junior Miner ETF, which was off about 10%, and the VanEck Senior Gold Miners ETF, which was off about 7%, and gold itself was off 2.5%. So you can see in relation to that being up 4% pretty good. So big milestone for Osino was the definitive feasibility study they put out a couple of weeks ago. A solid study, after-tax NPV of $480 million and an IRR of 28%. So solid numbers there, and that's all based on a gold price of $1,750 an ounce. So pretty conservative there. So that's been the mantra for Osino, project de-risking for the last little while, and that continues. They do have a provisional mining license in hand, so they just have to kind of tidy things up there, and that's the focus of the work going forward here. So, the big thing, project financing package, that's expected to be arranged second half of this year, and to get that mining license into full mining license status, they have a couple of boxes to tick. The main ones of those are the relocation of some historic graves that they found on the project site. Now they have agreements in hand with the descendants, so they just have to kind of dot the I's and cross the T's on that and get the final government waivers. Same thing for some recent surface rights that they've acquired. Again, the ranch owners, they have deals in place with those. They need the government waivers, so they'll get those in due course. And the other big one is selling a 5% non-carried interest to some local stakeholders. So they've been working on that for a while to identify the proper group, and they'll work through that in due course. But the big catalyst is that financing package and a positive construction decision by the end of this year, and that would lead into production by late 2025 or early 2026. So de-risking continues, and that's the big catalyst for Osino going forward. And then we'll turn to our other top pick, Pan Global Resources. So again, Pan Global shares performed pretty well given the context. They traded flat during the quarter, but when you compare that to the global copper miners ETF, that was off about 3%, and copper itself really took a hit during the quarter, off about 8%. So flat performance, pretty good in that context. So we're very excited about Pan Global this quarter. The big thing is this Romana West surface access agreement that they got back in May. It opened up basically a doubling of their existing La Romana. Can't call it a deposit yet, but it effectively is a deposit that's about 1.2 kilometers long. So they've opened up land that's got all the signposts telling you that this thing continues for another kilometer to the west. You've got gravity geophysics, which is the big tool in the region that's identified neighboring mines. You've got other geophysical, you've got soil samples that, and importantly, about 300 meters from the furthest west drilling they've done so far, there's some Roman era workings literally dating back thousands of years. And those guys were mining native copper that they can see. So pretty good signposts that things continue on that western extension. And just in the last week or two, Pan Global put out preliminary results from the first 2 holes on that side of the project and came back with some visible copper and tin mineralization. So, we're waiting for the assays there, but pretty good sign that things are working over there. So, the company's been very much improved with news flow this year compared to last. It was a really big shortcoming. So they're doing a 25 to 30 hole program right now on Romana West. That's the key. They're also drilling one of the other multitude of targets they have, the Cañada Honda target. They've had some recent success there, highlight of 5.1 meter of 1.3% copper. And really they're just getting into that one and, believe they're kind of just on the edge of that. So positive assays there. And then another 20 holes, results from another 20 holes are still pending from the Zarcita target, which is up in the northern portion of the project, and back at the La Romana main emerging deposit there. So a lot going on, and the news flow has been much better. That's key. So we won't have these long periods of silence between results, and we can get some mojo into the stock and hopefully see some impressive results, especially from Romana West. And I think that could really get things going here. So that's it on Pan Global and our top picks for the quarter.
I will then turn over to my top pick, which actually is, Ascendant Resources. I have a speculative buy rating and a 40-cent price target. I've re-rated Ascendant Resources for my Q3 top pick, as a company has a number as well of near-term catalysts that make for a strong re-rating opportunity, not unlike Ascendant Resources. This is the second quarter I've had the company as my top pick. Unfortunately, performance did lag in Q2 with a negative 16% return. I think partly that was based on base metals markets losing steam. And I think also partly on the company potentially looking for an equity financing in the near term. Although as the recent announcement of a letter of intent from the UK Export Agency shows, a raise to get this project into production might not be as dilutive in terms of equity capital as a market might otherwise think. And a large part of that reason is that this is a very high return project with an estimated 53% IRR as per the PEA. That's a very outstanding number. And I think it's something that a lot of financing groups look for in terms of an attractive project. Going for Ascendant in terms of our catalyst-driven top picks portfolio is, number one, the upcoming bankable feasibility study, which significantly de-risks the project from the current PEA. Number two, the permitting process through Q3 and Q4. And number three, a construction decision and starting construction in 2024. The company's catalysts are clearly focused on getting the project on track to production. But I want to add that there is also good prospects for additional VMS lens discovery here as well. The company is following up on recent work on two significant geophysical anomalies that look very promising as additional volcanogenic massive sulfide targets, VMS lenses, like the current Lagoa Salgada North and South resource areas. And a discovery here could be a boon for further company growth. And just finally, in terms of valuation, for a company that is on the cusp of going into the final laps of building a real mine, the company is still trading very inexpensively. It trades at 0.2 times my NAV estimate. And in terms of some more direct metrics, it trades far below several geographically similar Iberian Pyrite Belt VMS project companies with similarly sized resources, but which are much farther behind the mine development curve than Ascendant Resources is. And really the point there being that this company is going to be coming out with a bankable feasibility study to get financing to build a project, whereas a lot of these other projects on the Iberian Pyrite Belt still have to go through the resource definition, economic study definition process. So this is very much a much more advanced de-risked project. So with that, I'll turn the call back to Rob.
Thank you very much, Gabriel. Now, in keeping to natural resources, we are very pleased to introduce Adam Gill, who is the newest member of the research team. Adam is working in Calgary in the Patch, and very shortly you will start to see Adam introducing his coverage names, where you will see the wealth of his knowledge and experience with over 15 years covering over, I believe it's 50 Canadian domestic and international names, where he draws on both boutique experience, moreover, the bulk of his time though with CIBC. Adam, we're very glad to have you with us on the call.
Thanks, Rob. Hopefully I'm coming in here okay. A little bit of a mic issue. Glad to meet everyone. As Rob said, we'll be rolling out research in the coming weeks here on some initial names. Just to give you, kind of my mindset on oil. I'm pretty constructive. I think we've seen a paradigm shift, not just in the way E&Ps are behaving on the public front. There's been a big emphasis now on free cash flow generation, paying dividends, doing share buybacks, and a lowering emphasis on growth organically. Obviously, guys are still building their companies, but a lot more through M&A than through the bit, which is positive. But you've also seen a shift in the OPEC dynamic as well, with them moving away from market position defense, which kind of got us into this bear market starting in 2015, and now moving to protect price, driven by the largest producer, Saudi Arabia. So I think from an oil perspective, that's something to keep in mind when thinking about this sector. Natural gas, a little more tricky. Obviously, there's some very high quality Canadian gas names. Winter weather still is a big factor for gas. And unfortunately, we got hit with a very warm winter last year. Unfortunate if you're a gas producer. Maybe not everyone thought that was unfortunate. But, we're starting to see some turning of the corner there as well. Power demand's been very high. LNG is through its spring maintenance period, and that has started to tick up in terms of their demand for feedstock for exports. And as long as producers stay relatively well behaved, and we get a hot summer, we could be a lot more constructive on price heading into the fall. So I'll leave it at that for now. Just wanted to give you a little bit of thoughts on where I stand on the commodity front, and look forward to interacting with you all in the future.
Great. And apologies that you're handcuffed and can't talk to names, but that will come shortly. But appreciate your insights from a macro perspective. With that, we are very happy to move it over to questions. So please drop in a chat, shoot an email, or just jump in with a verbal question. But perhaps to start things off, we'll turn to real estate, where David, the industrial sector has clearly been on a tear. Is there something that could derail the industrial fundamentals going forward, a reversion to the mean, or what's your comfort level there?
Yeah, the historically the biggest challenge for the industrial space would have been economic recession or any kind of economic softness, and you would have seen higher vacancy and eroding rents in that event. I don't think now is any different. I think the big difference is we're at a position where we've frankly never been so tight from a fundamental perspective. And so when it comes to our top pick in particular, you have a 40% buffer between market and in-place rents. So that's the first defense against economic recession. Your second defense is that the majority of new leases that are being signed, not only are you seeing leases at market, but they're allowing for anywhere between 4 and 5% annual increases to bake in future market rent. So as more leases get signed with those annual escalators baked in, you've actually got a buffer against future rent erosion because you've kind of front loaded your future rent growth. So recession's the answer, but there is quite a big buffer in the space.
Thank you. And then on that whole subject of rent increases, can you talk to Flagship? They've had some outsized rent increases year to date. Can you talk about the outlook there?
Yeah, Flagship's interesting. We talked about the pricing power that they have and the fact that they pushed through an 8% rent increase in January, and that was matched by an 8.7% increase in Social Security benefits and wage growth at the bottom quartile in the 7% plus range. So private equity would generally come in and would buy these assets and increase rent anywhere from 50 to 100%. This management team has been doing it for 25 years, and they would much rather have a methodical and kind of a more measured pace of rent increases. So, our view is that they will likely push through anywhere between 3 to 5% annual rent increases, frankly, forever, with higher rent increases if inflation were to be persistent, or if those Social Security benefits were to increase at an outsized pace. But really, they're a more methodical approach with a much longer view and horizon.
Thank you. And perhaps we'll turn to Stefan. With Quipt, it's a quality name, clearly, but they misstepped. Can you give a bit more perspective on the ATM program, that announcement, and both the response of capital markets and then the actions taken by management?
Yeah, the company made a large acquisition at the end of last year, Great Elm Medical. It was the largest acquisition to date. And they, very smart, synergistic acquisition. Company was doing great on the synergy side, and the stock was, on its way to $10. But in order to be a little more prudent, they did a financing for $35 million, which made sense. Thought that they needed to do it, but it just gave them a little more firepower on the balance sheet to do additional tuck-in acquisitions. So the company looked like it was in a good position. So the announcement of a $40 million at the market facility really did basically spook the market. I think one, just on the back of doing a $35 million financing, and also the size of it. So the 40 million people were concerned about dilution. I think it really came down to poor communication from the company. What they were really wanting to tell the market is that they have a lot of potential tuck-in acquisitions, and they just wanted something in place to be able to execute on those if they needed to. Fortunately, the market, I think, took it a little more negatively and heard that the equity is overvalued here and companies have to take money. So I just think just poor communication and a little too aggressive on the size of the ATM. Had they done something smaller, I don't think this would happen. So that's a long answer, but I think that's what drove the negative stock reaction.
Thank you, Stefan. And Gabriel, like part of your Ascendant thesis has been or is the revaluation opportunity. However, given the pressure you've seen on the stock, given this current market cap, how do they get attention, or are they too small to get attention? And has it hurt your revaluation thesis?
Yeah, generally speaking, when when companies hit this sort of 10 to 20 million market cap level, they do tend to lose a lot of attention from larger investors. So no doubt that has been potentially a problem for the story. But the main thing I point out is that the Lagoa Salgada project is a very high return project. So whereas the current share price may be reflecting anticipation of a financing overhang for the project, given that the project does have at least that 53% internal rate of return as estimated by the PEA. It is very much a high return project by any metric to compare in the mining space. So that at least gives the company an opportunity to compensate for what would otherwise be considered the potential for a lot of dilutive equity with non-dilutive debt. Really, I think a lot of financing groups out there are obviously going to be looking for very high return projects. This is very much one of them. And so, I don't really see this persisting, especially since the company did announce their letter of intent with the UK Export Agency with potential terms for debt financing. And the other thing that I point out is as I mentioned earlier, that very good exploration potential. Another VMS lens discovery here can significantly increase project resources and potential company size. And I think that would very much, catapult the market cap higher. Absent those two factors, I would say a company with such a low market cap could get lost beneath the weeds. But given that we have those two factors in the company's favor, I think that it can very much jump back into the forefront of companies that are able to get investor attention and get that revaluation with. That's my point of view on that question.
Thank you, Gabriel. Are there any other questions coming in?
Hey, Rob, can I ask you a question on Neat? Great little company, sort of best in breed in its space, quite well established in the pharma space, where it's leading in its sort of niche applications. When you look at its growth, do you see them growing further with the current customer base and dollars with more dollars from the current customers, or do you really feel like adjacencies and reproducing the success they've had with pharma players in other areas of the healthcare space or other industries is where the next leg of growth is coming for the company? That was a long question, but I think you get the picture.
Cool. And thanks, Stefan. What I did, since I have control over the slides, I could cheat and go back to the page on it. The company itself has long spoken to its land and expand strategy. And, over a year ago, they were talking about their client base at that time supporting a 50 million revenue run rate company. The company is very conservative by nature, and they've not yet updated or expanded that 50 million revenue target. So with the top 15, it should support something well in excess of 75 million. Further within the pharma vertical, you can go to second tier and third tier who will be attracted to the de facto standard of the Neat validation platform. And as you asked in your question, there are a lot of adjacent verticals where companies are held under very close scrutiny. The most obvious one is cosmetics, where manufacturing controls are critical. And we do see the company making initial inroads towards the cosmetics. But the company can lay out a path where their existing target market is 100, going to 500, going to 1 billion. So the general category of validation is almost open-ended for them, in that their validation platform ensures that machines are running efficiently, so there is a track record, and then takes on greater value where the output or the data analysis of that manufacturing process can be used for cross-examination by regulatory bodies of any ilk. So, this one has a lot of legs. For us, it supports our view of, buy as a standalone company. We also do reflect that at some point, when you are 15 of the top 20, probably 16 of the top 20, and then 17 of the top 20, you are the standard, and it's much cheaper for a global pharma to buy versus build. You cannot dislodge those contracts simply or cheaply or quickly. So that's why the takeout thesis is a big component of our overall return profile. Sorry, that's a long-winded answer. Okay, if I don't see further questions coming in, we thank everyone for their time. We thank everyone for their comments and insights on the discussion across the research team. We look forward to getting back in touch with you for our Q4 picks. We are optimistic that despite tough markets, we will be coming to you with a much more successful performance over the quarter. Albeit, we all do feel the pains of the marketplace, and we all do recognize that a focus on small cap, high growth isn't necessarily consistent with current market conditions, but this is our thesis, this is our focus, this is our discipline. And with that, I thank everyone and wish everyone good fortune in their investments. We are available for any questions that may follow. Thank you again.